meantime, the market has actually turned for the worse. We are now in the red at the lowest point of the trading session. 19,735 is where we are at. And that pressure is actually stemming from the banking names. It's IndusInd Bank, which is on the back foot. Bank of Baroda is also down. And take a look at the stock of Power Grid. It was actually doing quite well in the trading session earlier, but now it's coming under pressure. But talking about one stock which is flying away in the trading session, that's Go Fashion. After the company reported a good set of numbers, Gautam Saraogi, the ED and CEO, joins us on the show now. Hi, thank you so much for making time and speaking with us. Well, the retailers highlighted that there is some sluggishness in demand earlier. What's the sense now, and how's demand panning out for you?
Yeah, so see, I think, look, the performance, I would rate the performance pretty good. In the current context of things, the consumer sentiment has been a little sluggish for last 2 to 3 quarters. We are very optimistic that I think we should have a very good festive quarter, Q3 this year, and we'll see a good jump. Q2 will be a quarter of revival. So hopefully this consumer sentiment should start improving in Q2, and by Q3 we should see sales back to normalcy. See, in general, we had estimated a sales of about 20% plus, and we ended up at around 15%. So in the context of how the consumer sentiment is, I think we performed well this quarter.
Gautam, you plan on growing at a 20% CAGR over the next few years. In Q1, your revenue has jumped 15%. So what's the sense in terms of your top line growth for FY24? Would it be below or in line with the 20% mark?
Currently, we see it to be in line with our 20% guidance, because we are hopeful that Q3 and Q4 also should do well once the consumer sentiment is revived. So as of now, we feel our estimates of a 20% growth on an annualized basis this year should be intact.
Okay, so that is intact in terms of guidance what you had earlier stated, but the revenues have jumped up by 15% year on year. Could you break it down in terms of value as well as volume? What was the breakup like?
See, I think, look, we are delivered a 15% revenue growth this quarter. The volume growth has been in the line of 7 to 8%. So if we are able to deliver a 20% overall value growth, company level growth by the end of the year, the volume should be around 10%.
And your margins have finally recovered this time round. Cotton prices have cooled quite a while ago, but your margins still didn't see a recovery until Q4. But now, is the recovery sustainable?
See, I think we've delivered good margins. We've delivered about 32 to 33% of post-Ind AS EBITDA with about 13.8% of PAT. So I think on an annualized basis also, I think we will be pretty optimistic that we'll be able to maintain these margins. See, because these margins for us come down from gross margins, and our product usually are sold on full price. With such a high full price sales ratio, we see our margins consistently maintaining at a gross margin level and also at a PAT level.
Okay, maintaining the margins, but you've been expanding your footprint as well. 127 stores were added in the last year. Talk to me about what the trajectory is going to be like in this year.
Yeah, so our guidance of 120 to 130 stores is going to continue. Last year, we successfully opened around close to about 130 stores last year. And this year also in Q1, we've opened about 25 net stores. So the year through projection of 120 to 130, I think we should be easily able to achieve.
You highlight how some of your new stores are performing then. You talked about 130 stores that you added last year. But what we understand from analysts is that at least the last 6 months, the performance of your new store hasn't been that great. So have you managed to break even on some of them?
See, usually for any of our new stores, it takes about 3 to 4 months for it to operationally break even. And many of our new stores have done fairly well. Considering that the overall demand has been a little sluggish, our new stores have slightly underperformed because of the environment scenario, because of the consumer environment scenario. But from a break-even perspective, and within 3 to 4 months of it opening, it reaches break-even.
So, given the rapid expansion of stores and a cluster-based approach, what is the kind of cannibalization of volumes that you've witnessed from your existing stores?
See, I think the cannibalization will be limited, see, because we are in a very virgin market as far as bottom wear is concerned. So because we are in such a virgin market, cannibalization impact should be very limited in our space. So considering that we are growing in clusters, our same store sales growth, we expect to have positive volume growth as far as same store sales growth is concerned.
Okay, point taken. But you have also been adopting an omni-channel strategy, right? What are the plans to increase sales from the online presence as well as the other channels? And how will the total sales mix evolve?
See, the omni-channel will just boost the revenues of the stores, which will in fact strengthen the SSSG what we are guiding. So from a sales mix perspective, the online sales, which are at about 3.5%, will keep growing at a healthy CAGR, and eventually maybe it gets closer to 7-8%. But that will happen over a longer period of time. But the immediate upside of the omni-channel will come up at the store levels, which will strengthen the SSSG what we are guiding.
And your working capital cycle has also declined by 19 days. What is driving this? Is this improvement likely to continue?
See, right now we have optimized our inventory by about 19 days. We have optimized our inventory, if I'm not wrong. We have reduced it from 120 days to about 107 days. About 13 days of inventory we have reduced. So our further expectation is that we want to bring it down to about 90 to 95 days, which will happen by the end of the year. This rationalization will happen by the end of the year. So we are looking to bring down our working capital days to about 120 to 125 days. This will happen mostly on the basis of inventory.
Okay, so given all of this, what's the market share currently? And with the store expansion plan that you have lined up, does it mean that the advertising campaigns, etc., will also be on the higher side? And what will be the overall market share that you are targeting?
See, our market share in the branded bottom wear space as on FY20 was about 8%. So at the growth rate what we are having, we would like to reach, our first target would be to reach double-digit market share. So probably have double-digit in the next few years. So it was 8% as on FY20. So first target is to reach double-digit.
All right. We'll let you go on that note. Thanks so much for taking time out and joining in. That's the management of Go Fashion, 10% volume growth by FY24. And he's saying that they want to bring down their working capital cycle to 120 to 125 days.